The FOMC minutes dropped, and the dollar crashed. Treasury buybacks, not the Fed, triggered this move. Euro to US dollar just broke 1.1670. Pound sterling to US dollar hit 3-month highs. But here's the trap. The hawkish Fed is still there. I've got 2 scalp setups and 1 swing trade with exact levels. Full breakdown in the main video. Click the link. Your P&L will thank me later. The FOMC minutes were supposed to be the dollar's moment. 3 dissents calling for a hike. A 9-3 vote that actually understated the breadth of support for tightening. Every textbook says that's dollar bullish. Every textbook just got ripped up. Instead of the dollar rallying, Euro to US dollar surged past 1.1670, pound sterling to US dollar hit 3-month highs above 1.3600, and the greenback tumbled to its lowest level in 3 months. And here's the thing, the minutes themselves were hawkish on the margin. But the market didn't care. Why? Because the Treasury Department dropped a bombshell that changed the entire calculus. They announced they would double their long-dated buyback operations, capping them at $4 billion through early November. What does that mean? It means the Treasury is actively suppressing long-end yields. And when long-end yields fall, the dollar loses one of its primary pillars of support. The market front-ran the minutes entirely. By the time the FOMC document hit at 7 p.m. British Summer Time, the dollar was already in free fall. The hawkish language was irrelevant. The buyback news had already done the damage. This is the kind of event that separates traders who read headlines from traders who understand market plumbing. I've seen this exact dynamic play out before. A central bank signal gets completely overridden by a treasury or fiscal policy move. It happened in 2023 with the debt ceiling drama. It happened in 2024 with the Treasury's quarterly refunding announcements. And it's happening again right now. The question isn't whether the Fed is hawkish. It's whether anyone cares while the Treasury is actively buying bonds. What I'm watching right now isn't just the price levels. I'm watching the yield curve, the dollar funding stress in the crosses, and the positioning data. And what I'm seeing tells me this move has legs, but not for the reasons most people think. Here's my bottom line for the week ahead. On Euro to US dollar, I am constructively bullish above 1.1620. The pair has broken decisively out of the 1.1500 to 1.1600 range that held for the past 2 weeks. We are now trading at 1.1673, up over 0.85% in a single session. The next target is 1.1720, the August 2026 swing high, and then 1.1780, which aligns with the 200-day moving average. My invalidation level is a daily close below 1.1550. If we lose that, the bullish case falls apart and we are looking at a retest of 1.1480 on pound sterling to US dollar. I am bullish but cautious. The pair is at 1.3623, having rallied to 3-month highs. UK CPI accelerated to 2.9% in July, up from 2.6% in June, with core steady at 2.6%. That's supportive for sterling, but the real driver has been dollar weakness, and that's a fragile foundation. My key level is 1.3550, a recent swing low that has held 3 times in the past 2 weeks. A daily close below that opens a path to 1.3450. On the upside, resistance sits at 1.3650, then 1.3720. Here's my question for you. Are you buying this dollar weakness, or do you think it's a trap? Drop your view in the comments. I read every single one. Let me walk you through the chart starting from the weekly time frame and drilling down. Weekly chart. Euro to US dollar has printed a decisive bullish engulfing candle this week, breaking above the 200-day moving average, a level that has acted as resistance since early August. The pair is now trading above all major moving averages. MA5 at 1.1550, MA10 at 1.1520, MA20 at 1.1480, MA50 at 1.1466, MA100 at 1.1520, and MA200 at 1.1490. That's a clean, bullish alignment. The RSI on the weekly is at 58, comfortably in bullish territory but not overbought. There's room to run. Daily chart. This is where the story gets interesting. Euro to US dollar has broken decisively above the 1.1600 to 1.1650 congestion zone that held for 2 weeks. The breakout was backed by volume and came with a clean daily close above resistance. The MACD on the daily just triggered a bullish crossover, with the signal line moving above zero. The RSI is at 68, flirting with overbought but not yet at extreme levels. The Bollinger Bands are expanding, which suggests volatility is increasing and the trend has momentum. What stands out to me is not just the breakout itself, but the way it happened. We had a clean rejection of the 1.1500 level on August 17th, followed by a slow grind higher into the FOMC release. Then the Treasury news hit and we got a straight line move to 1.1673. I've seen this exact pattern before. A slow accumulation phase followed by a violent catalyst-driven breakout. The tell is that the move didn't fade. We held above 1.1620 through the Asian session. That tells me there's real buying pressure, not just short covering 0.4-hour chart. The 4-hour RSI is at 72, overbought. The stochastic is also in overbought territory. This suggests we could see a short-term pullback or consolidation before the next leg higher. The MACD on the 4-hour is showing strong bullish momentum, with the histogram expanding. The key support on the 4-hour is 1.1620, the former breakout level that should now act as support. Below that, 1.1580 is the 50-period EMA on the 4-hour 0.1-hour chart. On the 1-hour, we are seeing a classic ascending channel. Price is holding above the 21-period EMA at 1.1625. The RSI is at 65, pulling back from overbought but still bullish. The immediate resistance is 1.1680, then 1.1700, then 1.1720. Support is at 1.1650, 1.1620, and 1.1580. Now, if you think euro to US dollar is the only story here, you're missing half the picture. Let me show you what's happening with pound sterling to US dollar, because the dynamics there are completely different, and that's where the real opportunity might be. Weekly chart, pound sterling to US dollar has printed a strong bullish week, now trading at 1.3623, 3-month highs. The pair has broken above the 100-day SMA and is approaching the 200-day SMA. The RSI on the weekly is at 62, bullish but not stretched. The MACD is showing a bullish crossover that's gaining momentum. The pair has formed a series of higher highs and higher lows since the June lows, daily chart. This is where the picture gets more nuanced. Pound sterling to US dollar has been consolidating in a wide range around 1.3523, and we've now moved towards the upper boundary. The daily RSI is at 65, the stochastic is near 97, that's extremely overbought. A pullback or consolidation would be normal here, not automatically bearish. The key resistance is 1.3650, then 1.3720. Support is at 1.3550, a level that has held 3 times in the past 2 weeks, then 1.3500, and 1.3450. This level reminds me of the August 2022 squeeze. Back then, pound sterling to US dollar was stuck in a range between 1.3500 and 1.3700. Everyone was bearish on sterling, and then BOJ intervention triggered a massive short squeeze that took cable to 1.4000 in a matter of weeks. I'm not saying history will repeat exactly, but the positioning setup is similar. According to the latest COT report, net short exposure on pound sterling to US dollar was reduced by 8,000 contracts across large specs and asset managers. There's still a lot of short positioning to be squeezed. 4-hour chart. On the 4-hour, we are seeing a compact consolidation range forming around 1.3607, extending between 1.3588 and 1.3618. The MACD signal line is above zero but beginning to turn downwards. The stochastic is trending downward from overbought towards 20, indicating short-term downside pressure. This suggests we could see a pullback towards 1.3572 before another leg higher. 1-hour chart. On the 1 hour, sellers are active around 1.3633 to 1.3641. A rejection from this zone could target 1.3556. Support sits at 1.3588, then 1.3572. Now let me connect the dots on what's really driving these moves. The headline story is simple: the dollar is weak. But the reason for that weakness is more complex than most traders realize. The Treasury buyback bombshell, the primary catalyst for this week's dollar sell-off, was not the FOMC minutes. It was the Treasury's announcement that it would double its long-dated buyback operations, capping them at $4 billion through early November. This is a massive intervention in the bond market. When the Treasury buys back long-dated debt, it increases demand for those securities, pushes prices up, and yields down. Lower yields make dollar-denominated assets less attractive, weakening the currency. This factor outweighed the hawkish message from the FOMC minutes entirely. The FOMC minutes, what they actually said: the July FOMC minutes showed a much more hawkish stance than the 9-3 vote suggested. 3 members, Harker, Kashkari, and Logan, voted for a 25 basis point hike, the first time since September 2016 that 3 participants have dissented in the same direction. More importantly, the minutes showed that the number of policymakers who considered tightening in response to high inflation was much higher than 3. The main message was clear: if inflation doesn't continue to decline, rates will have to be raised. But here's the catch: that was the Fed's stance 3 weeks ago. Since then, we've seen significantly weaker labor market data and inflation that continues to decline. The market is forward-looking, and traders have already priced in a more dovish federation. The minutes were old news. The Treasury buyback news was new. That's why the dollar fell. The UK inflation story, £4 sterling to US dollar, the domestic story is more complicated. UK CPI accelerated to 2.9% in July, up from 2.6% in June. Core CPI held steady at 2.6%. UK services inflation is running at 5.6% year-on-year, and wage growth remains above 6% for the private sector. The BOE's own decision-maker panel survey shows firms expect to raise prices by 4.2% over the next 12 months. This is a central bank's nightmare. The UK economy is stagnating. The latest GDP revisions show a marked slowdown in Q2, but inflation remains stubbornly above target. The BOE is boxed in. Cut rates and risk reigniting inflation. Hold rates and risk deepening the recession. The market has been pricing BOE rate cuts for Q1 2027, but sticky inflation is making that increasingly difficult to justify. Upcoming calendar. For the next 24 to 48 hours, here's what I'm watching. Today brings German PPI data and the Bundesbank's monthly report. Tomorrow, we have flash PMIs for the Eurozone, UK, and US. These will be critical for gauging the health of all 3 economies. And next week, we have Chairwash's Jackson Hole debut. That could be a major market mover. Here's what I want to know. Are you trading the Treasury buyback story, or are you fading this dollar move? Let me know in the comments below. Now let me give you the setups I'm actually watching. Remember, these are my personal levels. Your risk tolerance and account size may differ. Always manage your own risk. Scalp setup 1, Euro to US dollar long, mean reversion, trigger. Buy on a pullback to 1.1620 to 1.1630 with bullish reversal confirmation, hammer candle or bullish engulfing on the 5-minute. Entry, 1.1625 stop loss, 1.1595, 30 pips, take profit 1, 1.1660, 35 pips, take profit 2, 1.1685, 60 pips, R&R, 1.16 to 1 on TP1, 2 to 1 on TP2 invalidation, close below 1.1580. Why this setup? 1.1620 is the former breakout level that should now act as support. We've seen a strong breakout above this level, and a pullback to retest it as support is a classic low-risk entry. The 50-period EMA on the 4-hour is at 1.1580, providing additional support below. Scalp setup 2, Euro to US dollar short, breakout failure, trigger. Sell on a rejection from 1.1700 to 1.1720 with bearish reversal confirmation, shooting star or bearish engulfing on the 15-minute. Entry, 1.1705 stop loss. 1.1735, 30 pips, take profit 1. 1.1670, 35 pips, take profit 2. 1.1640, 65 pips, R&R. 1.16 to 1 on TP1. 2.16 to 1 on TP2 invalidation, close above 1.1740. Why this setup? 1.1720 is the August 2026 swing high and a major resistance level. The RSI on the 4-hour is already overbought at 72, suggesting we could see a rejection. If the market fails to break this level, a short scalp offers a favorable risk-reward. Swing setup, Euro to US dollar long, breakout continuation, trigger. Buy on a daily close above 1.1720 with bullish momentum, MACD bullish crossover confirmed, RSI above 60. Entry, 1.1725, market order on daily close above 1.1720, stop loss, 1.1570, 155 pips, take profit 1. 1.1780, 55 pips. 200-day moving average take profit 2. 1.1850, 125 pips, R&R. 0.35 to 1 on TP1, 0.8 to 1 on TP2 invalidation, daily close below. 1.1550. Why this setup? If Euro to US dollar can close above 1.1720 on a daily basis, it opens the door to a move towards 1.1780 and potentially beyond. The 200-day moving average at 1.1780 is the next major resistance. The fundamental backdrop, Treasury buyback suppressing yields, dollar weakness, supports further upside. Now, if you're more interested in the pound, stick with me because the setups on pound sterling to US dollar are even more interesting right now. Scalp setup 1, pound sterling to US dollar short, range top rejection, trigger. Sell on a rejection from 1.3633 to 1.3641 with bearish confirmation on the 1-hour chart. Entry, 1.3635 stop loss, 1.3665. 30 pips, take profit 1. 1.3600, 35 pips, take profit 2. 1.3572, 63 pips, R&R. 1.16 to 1 on TP1. 2.1 to 1 on TP2 invalidation, close above 1.3670. Why this setup? 1.3633 to 1.3641 has been established as a resistance zone on the 1-hour chart. The stochastic on the 1-hour is showing bearish divergence, and the MACD is beginning to turn lower. A move towards 1.3572 is the expected short-term path. Scalp setup 2, pound sterling to US dollar long, support bounce, trigger. Buy on a bounce from 1.3550 to 1.3560 with bullish reversal confirmation. Entry, 1.3555 stop loss, 1.3525, 30 pips, take profit 1. 1.3590, 35 pips, take profit 2. 1.3620, 65 pips, R&R. 1.16 to 1 on TP1. 2.16 to 1 on TP2 invalidation. Close below 1.3500. Why this setup? 1.3550 is a recent swing low that has held 3 times in the past 2 weeks. This is a significant support level with multiple tests. A bounce from here offers a good risk reward for a scalp back towards the range highs. Swing, pound sterling to US dollar long, breakout continuation, trigger. Buy on a daily close above 1.3650 with bullish momentum. Entry, 1.3655, market order on daily close above 1.3650, stop loss, 1.3500, 155 pips, take profit 1. 1.3720, 65 pips, mid-August high take profit 2. 1.3850, 195 pips, R. 0.42 to 1 on TP1, 1.26 to 1 on TP2 invalidation. Daily close below 1.3500. Why this setup? If pound sterling to US dollar can close above 1.3650, it breaks the recent consolidation range and opens the door to a move towards 1.3720 and potentially beyond. The fundamental story. UK inflation above expectations, dollar weakness, supports further upside. However, the overbought conditions on the daily suggest caution. Let me take 30 seconds to talk about something that matters more than any setup I've just given you: risk management. The market is in a volatile regime right now. We've got Treasury buybacks, hawkish FOMC minutes, Middle East tensions, and a dollar that's being pulled in multiple directions. This is not a market where you want to be aggressively leveraged. My rule for this environment: position size at 50% of normal. If you usually risk 1% per trade, risk 0.5%. Give yourself room to be wrong. The setups I've given you have tight stops on the scalps, 30 pips, which means you can get stopped out quickly if the market whipsaws. That's fine. That's the cost of doing business. What you don't want is to get caught in a 100 pip move against you with too much size. I learned this lesson the hard way back in March 2020, during the COVID crash. I had a perfectly good analysis on euro to US dollar. Everything pointed to a bounce. I sized up because I was confident. The market dropped another 200 pips before it turned. I got stopped out at the exact bottom. I was right on direction, wrong on timing, and my account paid the price. Since then, I've never traded a volatile environment with full size. Size down, stay in the game. One more thing. Watch the euro to pound sterling cross. It's at 0.8577, and it's telling us a lot about relative central bank credibility. If euro to pound sterling starts moving higher, it means the market is pricing a more hawkish ECB relative to the bow. If it moves lower, the market is favoring the pound. This cross is often a cleaner trade than the dollar pairs. Because it isolates the policy divergence without the dollar noise, let me wrap this up with the key levels you need to have on your screen. For euro to US dollar, support at 1.1620 and 1.1550. Resistance at 1.1720 and 1.1780. The bias is bullish above 1.1620. Bearish below 1.1550 for pound sterling to US dollar. Support at 1.3550 and 1.3500. Resistance at 1.3650 and 1.3720. The bias is cautiously bullish above 1.3550. Bearish below 1.3500. The big picture is this: the Treasury buyback story is the dominant driver right now, not the FOMC minutes. As long as the Treasury is aggressively buying back long-dated debt, yields will be capped and the dollar will struggle to find a bid. But don't get complacent. The Fed is still hawkish underneath, and if the market's focus shifts back to rate hike expectations, the dollar could reverse violently. I'll be back on Friday with my weekly wrap-up, and Sunday night with my full preview for the week ahead. Make sure you're subscribed and have the bell turned on so you don't miss them. Before you go, drop your euro to US dollar and pound sterling to US dollar levels in the comments. Where are you looking to enter? Where are you placing your stops? Let's build a community of traders who actually share their thinking, not just the usual emoji spam. This is Trade Meridian Decode signing off. Trade smart, manage your risk, and I'll see you in the next one.